Hey guys, it's Pete and welcome to a new video. Today I'm going to be reviewing Plum. Now Plum is available on Android and it's available in the App Store for those of you who use an Apple iPhone. Plum is one that people have asked me to review on a number of occasions. It's quite popular here for its tools around helping you budget and save money, but I'm going to be looking at it in this video purely from the perspective of, is it something that you can use as a first-time investor to get started on the stock market? Now, I am a qualified financial advisor. I've been in the industry for 15 years. I've worked in banking and wealth management over that period of time. So I'm going to be giving my insider views of whether the information they're giving you is adequate, whether the information they're giving you is clear enough, and whether I can see enough information to make them a worthwhile bet for you as a first-time investor. So let's jump over to my computer. I'm going to walk you through what I see on their website. Hey guys, so welcome to the Plum website. This is quite bright, it's quite white. There's quite a lot of space on the left and the right. Didn't mean for that to rhyme, but that's just me. I'm bad like that. But I guess what they're trying to do here is they're trying to get you to focus your attention on that center part of the screen. And here, clearly, it gives you a really nice introduction to who they are, what they basically do. The AI assistant that helps you grow your money, set more money aside, invest in things that matter, and reduce those pesky bills. Get started for free in 2 minutes. Now, I will challenge that because I actually signed up to Plum in the pre-work that I did for this video, and it took about 7 email links for me to get access to the app. Now, we're not going to hold that against them. We're in Corona times after all, and they may just have had a technical glitch. One thing that I do like on here, though, is they are telling you it's available on Apple Store, Google Play, but more impressively, they have over 650,000 customers. That's actually quite a large number. Very, very impressive indeed. And more impressive than that is the fact that they have 4.7 as a rating. And this is Apple Store ratings from over 10,000 reviews. That is something that any business would be extremely proud about. And it's definitely something that they should, hold up as they are doing right here as a kind of nod to what they're doing. And you scroll down here again, it's very, very clean, very, very clear. They point you in the right direction as to what they're actually doing for you, what they can actually do. And they're talking about, the 3 steps: link your bank, Plum automatically sets money aside, you're better off. So 3 simple steps to their service and how they're going to help you be better with your money. And I think one of the things that these companies do really, really well is the fact that they do help you make the most of the funds that you have running through your account. How many times have we been shopping, and if we've used cash, we've got a little bit of change and we spend that bit of change? Now, obviously in today's society, we're more likely to use things like Apple Pay or contactless, and therefore that little bit of spare change being siphoned off into a separate account to help you, accumulate some funds on the side is always a great thing. And I think that's something that Plum and a number of other providers that do this do really, really, really well. What I'm really interested in for the purpose of this review, though, like I said at the top of this video, is I'm interested in what they can do to help you grow your money. So what they have available, what their capabilities are as an app for use by first-time investors. That's what I'm interested in. So let's focus our attentions on this part of the website. Now, again, this is very, very clean. I like the way they segment this into sections. So you hit your sections at the top. It's very much about an introduction. You get to know a little bit more about what that top section is. And then you move on to this part here, and it's all about grow your money. And they're talking about own a piece of Google and Apple. Those are industry names, household names, good companies, fantastic companies. Ride the wave of emerging markets like China and Brazil, or back socially responsible companies. Okay, capital at risk. That is a disclaimer that they have to put on the website. That right there. As a financial advisor, as an industry insider, I already have a few questions which I hope they're going to answer on the next screen for me. Owning Google and Apple, that's great, but I would like to know how they're actually doing that. How are they purchasing Google and Apple stock for you as their customer, bearing in mind that the share price in these companies is quite high? If you're only saving, a pound a week or so, how are they going to do that? How does that actually benefit you? So I'd like to know how they're executing those trades, how they're making that possible, and whether they're going to give a bit more information about how they're doing that. I also have a little bit of a question around emerging markets like China and Brazil. These markets can be quite volatile. So again, I'd like to know how they package this, if it's part of an investment portfolio. Those are the things that I'd like to see when I click learn more about investments. So here we are. Okay, this is kind of a regurgitation of what we just saw prior. Still the same thing. And again, they are highlighting that it's available on Apple Store, Google Play, and obviously their reviews and the number of customers they have. Past performance is not a reliable indicator of future results. Obviously, that is something that they have to put on there because it's an industry standard disclaimer that they have to put on. But for me, I'm a little bit disappointed that they haven't opened up with a bit more information. They've literally just repeated what's on the previous screen. I already know that you're talking about owning a piece of Apple and Google. I already know that you've told me that it's all about riding the wave of emerging markets like China and Brazil. I know that already. I want to see more information. So hopefully when we go down, that's what we're going to get. Okay, start investing with as little as £1. Open your Plum ISA and become an investor in 5 minutes. Okay, I'm relieved that they're offering ISAs. ISAs are tax-free. If you don't know what an ISA is, the government, if you're here in the UK, allows you to save £20,000 every single tax year. The tax year runs between April the 6th and April the 5th each year. We're now currently, today is the 30th of March, which means that we are coming to the end of the current tax year. The new tax year will start on April the 6th. So if you have £40,000 lying around, this is an opportune time for you to put some money away, invested in the stock market, and have it away from the tax man for tax purposes. Everything that you invest, plus any growth that you achieve whilst it's invested, is completely tax-free. That's a huge benefit of an ISA. And unfortunately, if you don't use your ISA allowance in any one tax year, you don't get to carry it forward. You lose it forever. So right now is an opportune time, and I'm happy that they are offering investment by way of ISAs with Plum. That's a great thing. So let's have a look and see what we're doing here. So what they're saying is we've handpicked a range of simple, approachable investments. So whether you're a first timer or a seasoned pro, you can find something to suit you. Okay. Now they've got sliders here, and I guess this is where they give kind of like an indication or a projection of their investments. £250 per month is what they put here. You can slide that up and down. Yes, you can. But let's just stick with £250 a month for the time being. They've got investment term here. You can slide that up and down, but let's stick with 10 years, which is their default. And I think what they're saying here, well, what they are saying here is if you save £250 per month in a bank, you're only going to have 30,241. If you invest it, it's 45,182, so just under £15,000 in return for investing over putting the money in a bank. That number is actually quite compelling, very, very compelling. And you also need to consider that if you have money sat in a bank account, you've obviously got inflation eating away at your capital. So investing is always, always advisable if you have any spare cash lying around, because the whole point of investing is that you want to beat inflation. Now, one thing that they don't do here, which I'm surprised at straight away, is they are not giving you a range. So I have no way of knowing as an industry insider, and this is something that all of the providers that I've worked with do, is they will give you 3 possible outcomes. So in this instance, they will say the middle of the road performance, if everything goes as we expect it to, or the stock performs as we expect them to, will be 45,182. Most providers, other providers, will give you an estimate of what they think it would be if the stock outperforms or the market outperforms. So in that case, it might be £50,000, and they should also give you an idea of what happens if the markets or the stock don't perform, which might mean that you have a third scenario where it's £40,000. Now, I'm surprised that these guys haven't done that with this right here, because the reality is markets go up and markets go down. There is no guarantee you're going to get £45,000. But I can tell you right now, if I was investing with them and I was a first time investor, not knowing what I know about the industry or not knowing what I know about the markets, if I didn't get £45,000 after 10 years, I would be extremely disgruntled, because they have not at this stage built up my expectation with it may well not perform, or it could outperform this amount. If I get back 50 grand, I'm not going to be too bothered. If I get back less though, I would be bothered. And I'm surprised that they've not given three possible outcomes like most other providers would do. Does that impact you as a first time investor? You may think not, but I would argue strongly that it does, because it doesn't set you up with the mentality or the understanding that your investment might not be worth 45,000. It might be worth 35,000 or 40,000. That's just the reality of investing. Now, down here, they have got, okay, let's have a look at what they said here. These performance calculations are illustrative only, and the figures can vary. Please note that a bank's deposit account is covered by the Financial Services Compensation Scheme, whereas Plum investments are not covered, and hence your capital is at risk. So this is a big thing for me. How are they executing these investments? Because if you use other investment apps, you will be covered by the Financial Services Compensation Scheme. So this tells me that they are executing these investments in a manner which means that you're not going to be covered. The reason why this is important is because if Plum were to disappear tomorrow and you have £30,000 invested with them, you say goodbye to your money. You have to realize that as a first-time investor. This, for me, rings alarm bells if I was a first-time investor looking at this. You need to have this protection in place as a first-time investor. Hopefully, we're going to learn a little bit more about how they're executing and how they're building these investments for you. But the fact that you're not covered by the Financial Services Compensation Scheme is a big red flag for me. I would want to put clients into a provider or with a provider that at least has this protection in place. At least. Because as a first-time investor, you don't want to invest your hard-earned cash, and for reasons outside of your control, Plum completely disappear overnight because of insolvency and you've lost all your money. But let's just continue on this page and see if we can glean any more information. So invest what matters to you. Choose between themes of companies and markets. These investments consist only of shares. Okay, now this is another big red flag for me. You are only invested in shares, which means that they don't have any diversification mechanisms, which means that all you're basically buying is shares in businesses. Now, for me, as a first-time investor, I don't believe that you should be looking at buying shares directly or investing in direct companies. You need to have a little bit of diversification. You need to manage your risk. The reason for that is, whilst these guys are investing in companies like Apple and Google and some of the big tech names, clearly they're talking about Facebook here as well as part of that. The share prices are quite high. And whilst these companies are quite stable, let's face it, last year or over the last 18 months, Facebook stock has been extremely volatile, particularly when it came to things like GDPR and data protection. The stock price of Facebook took an absolute hammering over that. If you've got all of your money invested and part of it or a big majority of it is invested in Facebook, you potentially face quite significant losses if they're not diversifying your portfolio well enough. Now, to diversify a portfolio, you need between 15 and 20 stock. That is the industry kind of standard. So my question here is, how many stock are they buying in tech giants, for example? And how are they diversifying this investment beyond just holding maybe a collection of 15 to 20 stocks? The fact that they're only holding equities or shares, it's a big problem for me, because as a first-time investor, the first thing that should be on your one of the first things that should be on your list of priorities is to make sure that you're able to manage your risk. And to do that, you need to have some bonds included within your investment portfolio. Bonds are almost like a counterbalance. Your shares or your equities is where you'll make the most money, but because shares and equities are so volatile, you need an element where your money goes into something where you have a known outcome. I explained this, I believe it's on episode 15 of the podcast. Then I would strongly recommend for you to go and find my podcast where I talk through the difference between equities and bonds. Let's just have a look at who they're looking investing in. Tech giants, yes. Facebook, Apple, Google, they've mentioned on here. They have said that it's a risk grade 6, risk level 6, and the average annual return being 19.8%. Okay, I get that. That's fine. They did put a disclaimer in there to say past performance is no indication of future performance. I'm sure they're going to have it here again. Remember these are average annual returns for the past 5 years, and past performance is not a reliable guide for future performance. As with all investments, your capital is at risk. So whilst this looks very, very attractive, I have huge question marks over how they're actually executing these trades. Clean energy, clean and green investing companies selected for their social responsibility. Who are these companies? That's the question. They don't actually give any examples of who these companies are in this example, in this instance. So tech giants, they've clearly reeled off Facebook and Apple. Who are the clean and green? They haven't actually given us any information there. Rising Star, invest in the growth of new giants in Asia and Africa. Who are they? How have they done their due diligence on these businesses is what I'd like to know. European Essentials, share of the large and mid-sized companies in developed markets in Europe. Yeah, best of British. So this will be the FTSE 100 that they'll be investing in here. Show of the 100 largest public companies in the UK. So you'll have Barratt Developments in there. You'll have BT, BP. You'll have Admiral, AstraZeneca. You have a whole host of others. Again, I covered all of this in the podcast where I talk about investment for beginners or investing for beginners. American Dream, shares of the 500 largest public. So that's the S&P 500 that they're investing in. So this is all very, very good on the surface. If you're a first-time investor, this looks extremely inviting and extremely exciting to know that you can own stocks in Facebook, you can own stocks in Apple. As an industry professional, though, I do have questions around how they're executing this. What due diligence have they actually done? How are they compiling the list of companies that they're purchasing? What mechanisms are they using to purchase this company? I'm hoping we're going to have a bit more information on all of those questions as we go through the screen. Invest at risk levels to suit you. Good for first-time investors. The investment mix shares, high potential return, and bonds, lower risk. Okay, so they are going to have a bond element to this, but then this confuses me as an individual because they're saying this part is only in shares. So I'm guessing what they're doing here is they're buying these and they're mixing them with bonds. So depending on which risk level you're going on or which risk level you select, you will have, all right, here we go. So low and slow and steady with 20% in shares. So your 20% will be in Apple, Facebook, the like, and 80% in bonds. Now, this puts me at ease in terms of the diversification and risk management. This is great. This is what I would like to see. So what they're saying here is if you're slow and steady, you'll get 20% in shares, 80% in bonds. You can expect moderate returns, but are better protected from losses. That's what you would expect for a slow and steady. However, how do you arrive at whether you are slow and steady? Because a lot of people don't intuitively know where they sit on any risk scale without being given a definition of what they, so Plum, consider as a slow and steady investor. There is no clear definition here. So that, for me, would raise questions as a first-time investor around how do you classify yourself as a slow and steady investor? What's their interpretation of that so that you can use that to make a decision on where you feel you sit? The average annual return on this one, they're saying, is 4.8%. This is a risk level 3, okay? Balanced bundle, 60% shares, 40% bonds. This fund offers a balanced combination of shares and bonds. Growth stack, which is 80% shares, 20% bonds. This fund leaves you most exposed to growth or losses in the market. That's a risk grade 5. So 3, 4, and 5 here. Okay. That makes sense. 3 risk levels. That's the least that I would expect for any company to be able to provide to their investors. 3 possible positions where you sit, 3 possible investment strategies that we employ for you. Again, my question is, if you're a first-time investor, how do you put yourself into one of those buckets? How do you put yourself into a slow and steady, a balanced, or a growth stack investor? There is no explanation here, so that's one question that I do have. Secure and helpful when it comes to money. There's no room for compromise. We built Plum from the ground up with your security and privacy in mind. Okay, so FCA regulated, humans on hand, strong privacy. Okay, what have we got here? What are your risks? Yes, that's standard stuff. They have to put on their shares and bonds. Brief explanation. What is an ISA? Brief explanation. Where is my money held? Okay, when you invest in funds like tech or growth, you open an investment account with GODA Regulated Services Limited, an FCA regulated firm. They buy the investments for you and keep them safe until you sell them again. Your money is protected by the FSCS guaranteed. Okay, so now you have some protection in play here because the third party they're using to purchase shares is registered and regulated with the FCA, and that's where your protection comes from. Now, the problem that I have with that is that only gives you protection on a little bit of your holding. So, for example, if you're a balanced bundle and you're buying 60% shares, this company here only deals with their shares or their share dealing activity. So when they're purchasing shares, so you only get cover for 6% of your holding in this example, as I understand it. So the question is, what happens to the remaining 40%? They're not explaining that here. So as a first-time investor, these will be questions that I will be urging you to ask. What happens to the remaining 40%? What protection do you have available? Actually, what I want to do is I want to actually do a little bit of research and find out who these guys are, because it's very important that you know where your money is going and you understand whether a company like this has good financial backing, whether they have good financial strength, because the last thing you want is to put your money with Plum, who then put your money with this company. And if this company folds, what happens? If they haven't got any financial strength behind them or financial backing, how do they survive scenarios where we've got the coronavirus right now? And I guarantee you, they're working at a much less capacity when it comes to staffing and resources. How do they survive that? So what I'm looking for here is I'm looking for a bit more information about them. Yes, we've got their address right here. Patrick Vaughan, Managing Director. They're based down in Salisbury, Wiltshire. Okay, so these guys look like a boutique investment managers firm. And the question, the problem that I have with that is, what financial strength do they have? Do they have a good bit of money in the background to prop them up in circumstances like where we are right now with the coronavirus? If they are forced to work at reduced capacity due to this, would the company still be standing if we're, still in lockdown in 3 to 4 months' time? Because if these guys go bust, what happens to Plum? What happens to everything that is invested? And how do Plum deal with the financial fallout if these guys go bust? This is a big, big question that you need to ask yourself as a first-time investor. This is your hard-earned cash. I can only give you this stuff because I'm a financial services professional, and I can only highlight this kind of stuff because these are the kind of things that I look at as a professional. I used to look at as a financial advisor, placing client money with people. These are all things that I would do as part of the due diligence process. As a first-time investor, it's important you do the same. This is your hard-earned money. You don't want it go into a company that potentially may not have the financial strength or the financial backing to exist if, things got really, really bad economically. At this point, from what I've seen about them, I can't see any financial figures. I'd have to dig around in their financial accounts to see what their turnover, their revenues are, what their profits are, so on and so forth. For the purpose of this video, I'm not going to go and do that, but that's certainly a question that you need to be asking yourself when you look at investing with these guys. I did a video, if you've not gone and watched it, where I reviewed Wealthify. Wealthify are backed by a huge company. They're backed by Aviva, who have £2.3 billion in cash as of their half-year results returns last year in 2019. That is what I would hope to have seen with people like Plum. Is your money locked? The investing money is different to depositing money in a savings account, and we cannot guarantee instant access. It usually takes 5 to 7 working days for any withdrawals to be completed. That's pretty standard. How much does investing cost? Okay, investing with Plum is part of the Plum Plus, which costs £1 per month, with the first month free. Additionally, our fund options have management fees, which go directly to our partners. Read more on pricing, because this is very, very important. What do the partners actually charge? There isn't really anything here that actually, here it is. So fund management fee of 0.53. So that's actually quite reasonable. Again, it is an important factor, but this should not outweigh the fact that there are bigger questions that you need to ask as a first-time investor. Don't go with them because they seem cheap. You need to go with them because they are right for you. So let's just jump back onto this page and see if there's anything else on there. There isn't. I'm slightly disappointed that we didn't get more information. When you go on to people like Wealthify, there's a lot of information. They walk you through the process. They guide you a little bit better than these guys do. And if anyone from Plum is watching this, I would really welcome to have a conversation with you guys. Maybe I've got the wrong end of the stick, but I can only give my views as a professional in the industry, someone who has advised clients, someone who has worked with financial advisors, worked in wealth management for, the best part of the last 15 years. There is more that could be done in terms of clarity for first-time investors here. Yes, it's very exciting for first-time investors to be invested in, stock like Apple, Google, and Facebook, as you've so eloquently highlighted here. But how are you going about doing this? How do they put themselves into this bucket of a slow and steady balanced bundle or a growth stack investor? What are the definitions? How do they come to that determination? Often, clients need to be led or given information about what each of these buckets mean in order for them to make an informed decision. This is what this is all about, guys, being able to make an informed decision. Plum is clearly very, very fresh in terms of the way the website looks. Yes, great reviews, 10,000 plus reviews, 4.7 on the Apple Store reviews. That's fantastic. 650,000 customers. They have to be doing something right. I would question how many of those 650,000 people are actually using their investment service. The investment service, as I see it, as it's presented on the website right now, does not stack up to other people like Wealthify, where there's a bit more of a clearer nudge, a clearer steer in terms of what's going on. That doesn't in any way means say that I am completely saying as a first-time investor you should not use them. No, absolutely not. What I'm saying is there are lots of questions to be asked, and I would hope that you guys ask those questions. So again, if you've got to this stage in the video, well done for sticking with me, but please go back, write down those questions that I've highlighted, and if you are going to be using Plum, please do ask those questions. They should be answers that they would be able to give you relatively easy. If you're asking these questions and they still can't give you a straight or informed, detailed answer, then that should tell you everything that you need to know. And again, this is not me bashing Plum. I can only give you information as I come across it and as I react to things that I'm seeing. And what I'm seeing right now is I have a lot of questions around their investment proposition. What they're doing with the day-to-day helping you save money is absolutely fantastic. But for first-time investors, lots and lots of questions. So that is my review of Plum. And I guess, guys, I think it's really important for me just to put out there that I don't have any affiliate links with Plum or any of their competitors, Wealthify, Moneybox, or anyone like that. This has been my unbiased view of Plum based on what I've been able to glean off their website. Now, full disclosure, I did sign up to the app. I didn't complete the sign-up process, though, because I had to then sync my bank account details, and I didn't want to do that. And I think, for me, the sign-up process wasn't as as smooth as I think it should have been. And I'm sure if I speak to anyone from Plum, they will say that it's not as smooth as what they would have thought or would have wanted it to be. So I think that's really important to state. But what I have highlighted in this video are questions that stick out to me as a financial services industry professional. I've been in this business now for 15 years across banking and wealth management. I've advised clients. I am a qualified financial advisor, and I'm hoping to use my experience to inform you guys if you're first-time investors. And some of the questions that I've raised here are questions that you need to ask them. It's very, very important. And you've got to recognize you are going to be investing your hard-earned cash. So you need to get this step absolutely spot on. But if you have watched this video and you have found value in this, I'm going to ask you to subscribe, smash the like button, and hit that notification bell. There will be more videos like this in the coming weeks as I get more into reviewing apps and giving you more content to help you along on your financial journey. If you don't follow me on social media, I strongly encourage you to find me on Instagram at Conversation of Money. And if you have not listened to my podcast, I've referenced it a couple of times through the course of this video. It's called the Conversation of Money podcast. It's available on Google Podcasts, Apple Podcasts, and Spotify. So please go and catch up on Investing for Beginners, again, which I've referenced a couple of times here. It will give you more of a basic understanding of equities and bonds and how investments actually built. There is another episode on this podcast where I talk about how investments are built. That episode is actually called How Investments Are Built. So again, there's 2 episodes that you can go and listen to get your knowledge and your foundation in investing as a first-time investor. But guys, thank you so much for watching. I look forward to seeing you next time. Take care.